So, we've been looking at the SEC staff guidance on liquid staking, and it's really stirring up a lot in the crypto world, right?
Yeah, exactly. It's kind of a double-edged sword. On one side, it opens opportunities, but on the other,
Right?
leaves a lot of questions unanswered.
Absolutely. I mean, the guidance is non binding, which means it doesn't really have the force of law. And that disclaimer, like the one saying it's not a rule or regulation, really highlights that it's the view of just one division within the SEC.
Right, so basically, it kind of signals a cautious step forward without committing fully.
Yep,
It's almost like saying, we're watching this space without locking it in.
exactly. And that opens it up for a debate. There's buzz because it might help both institutional and retail players get more comfortable with complex products like liquid staking, where users can earn rewards while keeping their tokens liquid.
Yeah, and think about it. It's like giving people a way to have their cake and eat it too. But then, some experts are warning it still leaves the door open for legal challenges, right?
Precisely. Scott Grelnick from Marinade mentioned that these guidelines could be contested eventually. And that leaves us wondering if the industry might need to push for more concrete market structure legislation.
I wonder though, isn't it a bit premature to call it a clear win for institutional adoption if the rules could change later? It seems like a bit of a risky gamble for some investors.
True. And there's also the technical aspect. Liquid staking isn't like traditional staking, it's complex. Because the operational models vary widely across protocols. For example, Sam Kim from Lido Labs pointed out that while liquid staking isn't considered a securities offering, there are nuances like restaking and cross-chain staking that still need clarity.
Yeah, it's like trying to fit new puzzle pieces into an old picture frame,
Absolutely.
right? And if the pieces don't quite match, the whole picture might look off.
Exactly. And then there's the taxation side of things. Some issues, like when staking rewards should be taxed, are still under legal review. Evan Weiss from Alluvial raised concerns, especially since these tax rulings could seriously impact how staking is integrated into more complex financial products like exchange-traded funds.
It's interesting because on one hand, you have regulatory clarity in some administrative aspects, while on the other hand, core areas like taxation and posthumous asset transfer rules remain murky.
Right, and Michael Hubbard from SOL Strategies emphasized that if a protocol sticks to purely administrative functions, issuing receipt tokens one for one without controlling returns, then the clarifications might apply neatly. But any deviation, and things get tricky.
That's a fair point. So, in a way, the guidance is kind of tailoring the rules to a very specific setup, while warning that anything outside those parameters might not be safe regulatory ground.
Exactly. And this specificity means that while some parts of liquid staking might see more institutional interest, the overall regulatory landscape might still experience disruptions down the line.
It really seems like a balancing act. On one hand, you want innovation and adoption, and on the other, you need legal certainty for long-term growth.
Yep, indeed. And as someone mentioned, the industry will likely need to push together for more robust regulatory outcomes and even more explicit market structure legislation to
That's a
ensure
must.
everyone plays by well understood rules.
So, overall, while it's a positive sign in some respects, there's still a long way to go before liquid staking is really cemented as a safe, regulated product in the crypto space.
Exactly. It's like a work in progress, exciting enough to drive innovation, but still with a lot of checks and balances to hammer out. The conversation is definitely far from over.
Absolutely. This mix of optimism and caution is what makes crypto regulation so fascinating to watch.